Investing your money wisely is crucial for building wealth, achieving financial goals, and securing your future. With a plethora of investment options available, it's essential to have a clear strategy tailored to your financial objectives, risk tolerance, and time horizon. Whether you're a novice or seasoned investor, here are the top 10 strategies to consider when putting your money to work. Establish a plan. Having established that you'd like to invest your money, you need to formulate a plan, taking into consideration a few questions. How much can I invest? What can I afford to lose? What is the goal of my investments? How long am I investing for to reach that goal? Do I know all the relevant investment definitions and terminology? Understand risk. Understand your risk tolerance and how you would feel if you lost some or all of the money invested. A common mistake for first-time investors is to believe they are more tolerant of loss than they actually are. So when riskier investments start to decline, they often panic and sell. Taking a considered approach to risk and reward will ensure you invest in line with your capacity for loss. Remember, anything you do involves risk. This also includes holding cash, as its buying power can be gradually eroded by inflation. Be tax efficient from the start. When it comes to investing, you will likely start off with a relatively small pot and might think tax efficiency is not a major concern. Remember, investing is a long-term strategy, and you need to consider the potential value of your investments in the future. Consider you're investing now for your retirement. By the time you reach retirement age, you may have acquired a considerable pot. If you haven't invested in a tax-efficient environment like a pension, then you may end up paying a considerable amount of tax. Ensure you are aware of this when you open an account. Diversify. As different markets rise and fall, a diversified portfolio of different types of investment funds can help to stabilize your portfolio over an economic cycle. Investing exclusively in particular markets, sectors, or companies can leave you exposed to unforeseen issues occurring in one particular area. Investing across a range of asset classes, regions, and sectors helps to mitigate potential losses and maximize long-term returns. Don't chase tips. The internet and media are full of punditry on shares or funds that are about to be the next best thing. Although these tips can sometimes be insightful, be careful not to chase them and constantly change your portfolio to take advantage of them by picking suitable investments to add to your portfolio. Remember that investing is a long-term endeavor, and success often comes from patience, discipline, and staying focused on your investment strategy rather than chasing short-term trends or tips. By adhering to a well-thought-out investment plan and avoiding the temptation to chase tips, you can build a resilient investment portfolio that stands the test of time. Invest, don't speculate. One of the most influential investors of history, Warren Buffett, said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Though penny shares with their perceived potential for high returns through cancer cures or prospective oil field can be very enticing, you need to consider what the long-term future value of the company is. Very small companies can be riskier purely due to the fact they may be less well regulated than the larger multinational corporations. It's false to think that taking increased risk guarantees you more money. You wouldn't bet on a pony in a horse race. To be successful, it's essential to understand your investment goals, risk tolerance, and time horizon, and choose an approach that aligns with your financial objectives. While investing provides the opportunity to build wealth steadily over time, speculation should be approached cautiously and considered only as part of a well-diversified investment strategy. By investing rather than speculating, you can achieve your financial goals while managing risk effectively over the long term. Stay informed about changes to tax laws and regulations that may impact your investment decisions, and consult with a tax professional or financial advisor for personalized tax planning advice. By being proactive and tax efficient from the start, you can minimize taxes and keep more of your investment returns working for you over the long term. Invest regularly. Investing little and often is sometimes better than investing larger lump sums. Researching investments has shown that even professionals find it is often better to invest regularly rather than to try time the market investing a one-off lump sum. In volatile times, you may also benefit from pound cost averaging, whereby investing regularly, you seek to even out the highs and lows of the market. By starting to invest early and regularly, you can take advantage of compounding. Consider diversifying across industries and sectors to minimize exposure to specific economic or market risks. Rebalance your portfolio periodically to maintain your desired asset allocation and ensure that your investments remain diversified. By diversifying your investment portfolio, you can mitigate risk and improve your chances of achieving long-term investment success. Reinvest. Unless you are looking for specific periodic income from your investment, then you might consider reinvesting any capital returned from funds or dividends back into your investment portfolio. History has shown that reinvestment of dividends from equities vastly increases your returns over the long term. Whether you're investing in stocks, mutual funds, or other assets, making regular contributions to your investment accounts ensures that you're steadily working towards your financial goals and building a strong foundation for your future financial well-being. Reassess. Once you start investing, remember it's a continuous process, so you need to periodically review your investments, personal circumstances, time frames, and risk tolerances, as all of these will change over the course of time. For example, as you get closer to your goal, you may want to reduce your exposure to riskier investments to try and secure your capital. In addition to assessing your own personal risk tolerance, check your portfolio's risk profile. As different top investments funds change in value, it will adjust their weighting in your portfolio, and this will affect the overall risk profile of your portfolio. Periodic rebalancing of your portfolio seeks to readjust this back to the desired level. By reassessing your investment strategy on a regular basis, you can ensure that your portfolio remains well-positioned to achieve your long-term financial objectives while managing risk effectively. Stick to your plan. Once you start investing for the first time, you'll realize it's very hard to ignore the chatter about market movements, commodities, share tips, inflation, interest rates, dividends, gold price, oil price. It's endless and is near enough constant with globalized markets. A true investor should be looking at long-term trends and macroeconomic factors that originally shaped their plan, and always keep these as their focus. Periodically review your plan to ensure it remains aligned with your goals and adjust it as needed based on changing circumstances, but avoid making impulsive decisions that deviate from your carefully crafted strategy. With patience, discipline, and a steadfast commitment to your investment plan, you can navigate the ups and downs of the market and achieve your financial aspirations. Investing your money wisely is not about chasing get-rich-quick schemes or trying to outsmart the market. It's about adopting a disciplined and well-thought-out approach that aligns with your financial goals, risk tolerance, and time horizon. By diversifying your portfolio, employing sound investment principles, and staying disciplined in your approach, you can build long-term wealth and secure a brighter financial future. If you found this video informative, hit the like button. Also, don't forget to subscribe and press the bell icon for watching more videos in future.